In this video, you'll discover 12 of the most common mistakes nearly every investor makes. As Warren Buffett himself says, I'll even confess to a few of my own along the way, just to keep things fair. Number 1. Trying to time the market.
Well, Charlie and I don't think about the market, and Ben didn't very much. I think he made a mistake to occasionally try and place a value on it. We look at individual businesses, but the stock market, I know of no one that has been successful at, and really made a lot of money predicting the actions of the market itself. I know a lot of people who have done well picking businesses, and that's what we're hoping to do.
Charlie and I never try to predict the market's movements. Even Ben Graham, our mentor, sometimes tried to assign value to the overall market, and I think that was one of his rare mistakes. We focus on individual businesses, not the market as a whole. I don't know anyone who's consistently made real money forecasting market behavior, but I do know many who've done well by carefully choosing strong companies. That's what we aim to do. Spending too much energy watching what the general market does is, according to Buffett, a major error. One so tempting that even his role model, Benjamin Graham, occasionally fell for it. Why is forecasting the market so attractive? Because the market, like the ocean, can lift or sink all ships. You might find an amazing company, but then COVID hits. You find another, but interest rates, inflation, or war crash its momentum. That's why people can't resist trying to predict macroeconomic waves. We all want to buy low and sell high. It sounds simple, but Buffett says there are only two things worth focusing on in life: what's important and what's knowable. Where the market will go next might be important, but is it knowable? I can't tell you what interest rate Jerome Powell will announce next, and honestly, I doubt Powell himself knows yet. And that's just one of hundreds of factors shaping the market. So what does Buffett do instead? He focuses on what's both knowable and meaningful, finding great businesses at fair prices. It's far easier to recognize a strong ship than to forecast every storm it will face. Some storms will sink one of your vessels, but others will carry them forward with powerful winds. Over time, you'll come out ahead by backing the best ships. Number 2, getting emotionally attached to your purchase price.
A stock at 50, somebody's paid 100, they feel terrible. Somebody else paid 10, they feel wonderful. All these feelings. And it has no impact whatsoever.
A share trading at $50 might make one investor miserable and another ecstatic. Someone who bought it at $100 feels terrible, while someone who paid $10 feels thrilled. These emotions, however, don't change the company's value one bit. Take a look at Amazon's share price over the past 5 years. Arnold bought in June 2022 and now sits on a modest 5% gain. Not bad for a few months. Ben bought in July 2021 and is down 38%. Katie invested 5 years ago and is up 133%. Now, the million-dollar question. Should they treat their Amazon stock differently because of their entry price? Perhaps Arnold and Katie should lock in profits, while Ben waits to break even? When you frame it that way, the answer becomes obvious: no. The only thing that matters when deciding whether to sell or hold today is the company's future potential. If Amazon's value rises 50% next year, all three investors, Arnold, Ben, and Katie, will enjoy the same 50% return from today's level. Stocks don't care what you paid. They have no sympathy. Whether you're up 133% or down 38%, the future return is the same from this point forward. Buffett says you should always approach investing as if you're starting fresh, with a blank slate. Soon, we'll discuss a closely related mistake, which Buffett himself calls his biggest of all time. Number 3, overly optimistic growth forecasts.
I think it's a mistake for any company to predict 15% a year growth, but plenty of them do. Very, very few large companies can compound their earnings at 15%. It isn't going to happen.
I think it's a mistake for any company to predict 15% annual growth, Buffett once said. Yet plenty of them do. In reality, very few large companies can consistently grow earnings at that rate. Have you ever thought, this stock looks pricey now, but if it keeps growing like this, it'll soon be a bargain? Many of us have. High-valued companies often justify their prices by promising extraordinary growth. But expecting that kind of performance is a dangerous assumption. That doesn't mean avoiding growth stocks altogether. Buffett loves companies that expand without needing massive reinvestment. What he warns against is growth at any cost, a mindset that took over Wall Street during the low interest rate years. When you buy a stock at 20 times earnings or more, strong earnings growth becomes essential for good returns, and that's not easy. Out of the S&P 500 companies from 2012 still trading under the same ticker today, only around 40 managed to grow earnings 15% or more annually. That's roughly 1 in 10. Picking that 1 out of 10 is incredibly hard. So investors chasing the next Tesla, Intuit, or Nvidia should be cautious, because sky-high growth expectations rarely hold forever. 4. Using too much leverage.
Really, the only way a smart person that's reasonably disciplined in how they look at investments can get in trouble is through leverage. I mean, if somebody else can pull the plug on you during the worst moment of some kind of general financial disaster, you go broke. And Charlie and I both have friends where that's happened to them.
Warren Buffett often warns that the only way a smart, disciplined investor can truly destroy their finances is through excessive leverage. Borrowing heavily to invest, he says, is the financial equivalent of playing Russian roulette. You might survive several rounds, but eventually, the odds catch up with you. Both Buffett and Charlie Munger have seen friends lose everything this way. Leverage gives an illusion of control and confidence, but in reality, it leaves you at the mercy of others, lenders, brokers, or market volatility itself. Investing was never meant to be a game for the impatient, yet nothing reveals desperation more clearly than a portfolio built on borrowed money. Why is leverage so dangerous? Because even if you're right about your investment, you can still lose everything before your thesis plays out. When you borrow, you don't get to decide when to hold or sell. Someone else does. Consider the story of Harry, a hedge fund manager who decided to short GameStop in March 2022. Confident that the company was overvalued, he borrowed and sold $1 million worth of GameStop shares while keeping $500,000 in margin as collateral. On paper, Harry's analysis was sound. GameStop was trading far above its fundamentals. But when the stock price unexpectedly jumped from $19 to $31 in a single week, Harry's position began to collapse. Because he was using leverage, his broker demanded more funds to cover potential losses, a margin call. Harry complied, adding another $600,000. Unfortunately, just a week later, the stock soared to $47. Now his broker wanted an additional $1.1 million, more than Harry could afford. Forced to close his position, Harry bought back the shares at a huge loss of $1.5 million. Ironically, his original prediction about GameStop's overvaluation might have been correct in the long run, but leverage made it impossible for him to stay in the game long enough to benefit. This is precisely why Buffett avoids both shorting and heavy borrowing. 5. Missing the forest for the trees.
We've made plenty of mistakes in acquisitions, plenty. The mistakes are always about making an improper assessment of the economic conditions in the future of the industry or the company. They're not a bad lease. They're not a specific labor contract. They're not a questionable patent. Those are not the things that count.
It depends on getting 3 things right: the future economics of the business and its industry, the quality and integrity of management, and the price you pay. If you understand these three factors, you don't need to obsess over every contract, patent, or technical specification. Buffett is known for being able to make investment decisions remarkably quickly, sometimes within 15 minutes. This isn't because he skips analysis, but because he simplifies it. Decades of experience have taught him that mastering the key variables matters far more than analyzing endless data. He doesn't need a 300-page due diligence report to recognize a sound business. The danger for most investors is the opposite, getting so deep into details that they lose sight of the big picture. When you focus too much on numbers, projections, or minor risks, you may miss the forest for the trees. The essence of good investing is balance, understanding enough detail to be confident, but not so much that you become paralyzed by it. A practical way to achieve this is by summarizing key insights instead of drowning in data. For example, after researching a company, you might assign simple ratings to its growth potential, business strength, and management quality, then compare those to other opportunities. This forces you to distill what truly matters instead of chasing every small fact. Investing is not about being the smartest analyst in the room. It's about identifying the essential drivers of value and acting decisively when the odds are in your favor. 6. Jumping over 7-foot bars.
Some businesses are a lot easier to understand than others. And Charlie and I don't like difficult problems. We'd rather multiply by 3 than by pi. It's just easier for us. Some people think that if you jump over a 7-foot bar, that the ribbon they pin on you is going to be worth more money than if you step over a 1-foot bar. And it just isn't true in the investment world at all.
Buffett's partner, Charlie Munger, likes to say that they prefer stepping over 1-foot bars instead of trying to clear 7-foot ones. In other words, they look for simple, understandable businesses rather than complex, difficult ones. Many investors believe that solving harder problems should yield greater rewards, just as in most other areas of life. Climbing taller mountains, solving tougher equations, or tackling more complicated projects. But in investing, the opposite is true. Simplicity wins. Trying to master industries you don't understand, forecasting unpredictable trends, or building overly complex valuation models usually leads to poor results. The collapse of long-term capital management, a hedge fund run by Nobel Prize-winning economists, serves as a stark reminder that brilliance can't compensate for overcomplication. Buffett's philosophy is clear. You don't get extra points in investing for difficulty. The goal isn't to show off intelligence. It's to make money safely and consistently. Find straightforward businesses with strong economics, capable management, and reasonable valuations. Those are the 1-foot bars worth stepping over. When you keep things simple and focus on the fundamentals, you not only avoid unnecessary risks, but also give yourself the best chance to succeed over time. 7. Shrinking your universe of opportunities.
We think the most logical fund is the one we have at Berkshire, where essentially we can do anything that makes sense and are not compelled to do anything that we don't think makes sense. I think it's a mistake to shrink the universe of possibilities. Ours is shrunk simply by size, but we don't set out to circumscribe our actions in any way.
Warren Buffett believes investors should never limit the range of possibilities they consider. At Berkshire Hathaway, he and Charlie Munger have structured their investment approach around one simple rule. They can do anything that makes sense and avoid anything that doesn't. Buffett cautions against artificially narrowing your investment universe. Opportunities appear in unexpected places, and no one knows where the next great business will emerge. The market rewards open-mindedness and punishes rigidity. He likens investing to fishing. A good fisherman doesn't stay in one spot all day if nothing is biting. He moves to where the fish are. In the same way, investors must remain flexible and willing to explore new areas. Restricting yourself to one sector, one geography, or one investment theme, whether it's only green stocks, only high-dividend companies, or only tech, can cause you to miss great opportunities elsewhere. Many fund managers box themselves in for marketing reasons. It's easier to sell a specialized niche fund than one with a broad, adaptable strategy. But markets don't reward narrowness. They reward curiosity and rationality. There's an important distinction between staying within your circle of competence and being narrow-minded. Understanding your limits is essential, but confining yourself unnecessarily can be costly. True skill lies in knowing when to explore new waters and when to stay where your knowledge gives you an edge. 8. Staying active all the time.
If you feel you have to invest every day, you're going to make a lot of mistakes. It isn't that kind of a business. You have to wait till you get the fat pitch.
Buffett often compares investing to baseball. Except in investing, there are no strikes. You can watch pitch after pitch go by and lose nothing. The goal is to wait patiently for the fat pitch, the right opportunity, and then swing decisively. Many investors make the mistake of thinking they must always be doing something, buying, selling, reacting. But constant activity usually leads to poor decisions. In the market, patience is not inaction, it's discipline. Imagine two tennis players. One plays 5 games a day, the other plays 5 times a year. Or two writers. One publishes weekly, the other writes only when truly inspired. In most professions, repetition improves skill. But in investing, the reverse is often true. Acting too frequently increases costs, emotions, and errors. There are seasons in markets. During bear markets, opportunities are plentiful. In strong bull markets, bargains are scarce. Sometimes, the best investment decision is to do nothing at all. 9. Diversifying too much.
If you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money, and I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich on their best idea.
If you really know businesses, he says, 6 wonderful companies are all the diversification you need. Adding more stocks beyond your best ideas often dilutes your returns rather than improving them. Very few people ever get rich from their 7th best investment idea, but many do from their best one. That said, diversification serves a purpose. If you don't have the time or interest to study individual companies, then buying a broad index fund is wise. It protects you from the risks of limited knowledge. But for what Buffett calls a know-something investor, someone who studies businesses closely, concentration can lead to superior results. Think of it like mixing drinks. Adding 30% liquor to 40% liquor doesn't make a 70% cocktail. It just weakens it. In the same way, adding mediocre investments to great ones only dilutes your performance. The perfect number of stocks depends on the investor, but the principle remains. Focus on quality, not quantity. 10. Confirmation bias.
There's no question the human mind, that what the human being is best at doing is interpreting all new information so that their prior conclusions remain intact. That is a talent everyone seems to have mastered. And Charlie and I have made big mistakes because, in effect, we have been unwilling to look afresh at something. That happens.
Perhaps one of the most dangerous mental traps in investing is confirmation bias, the tendency to interpret new information in a way that supports what we already believe. Buffett admits that even he and Munger have fallen prey to this. The human mind, Munger says, is like the human egg. Once one sperm gets in, it shuts down so that the next one can't. Once an idea takes hold, it becomes very difficult to let new facts change our view. This psychological quirk causes investors to ignore warning signs, overvalue their own opinions, and cling to losing positions. It's comfortable to be right, but in investing, comfort often comes at the expense of truth. Successful investors deliberately challenge their own assumptions. They seek disconfirming evidence, question their judgments, and remain open to being wrong. Humility, not stubborn confidence, is what prevents costly mistakes. We often seek out and interpret new information in ways that confirm our existing beliefs, when in reality, we should be doing the opposite. True rationality in investing means constantly reevaluating your assumptions, weighing the pros and cons of every company in your portfolio without bias. I'll admit, this has always been a challenge for me. But over time, I've discovered two useful remedies: the darling killing funnel and the bear pill. Let's say you want to hold 10 companies in your portfolio. Before finalizing those 10, you should study at least 20 potential candidates. And not casually. You should research each of them thoroughly, spending perhaps a day on everyone. Number 11. Following the herd humans.
Humans will continue to make the same mistakes that they have made in the past. I mean, they get fearful when other people are fearful. I mean, but when they get greedy en masse too. I mean, that's where Charlie and I have an edge. We don't have an edge particularly in many other ways, but we are able, perhaps better than most, to not really get caught up with what other people are doing.
Getting greedy when others are greedy, and fearful when others are fearful. Buffett and Munger often say that their real advantage lies in resisting this behavior. They don't get swept up by what everyone else is doing. Investing is full of paradoxes. In most areas of life, following the crowd makes sense. If your family and friends like your partner, that's probably a good sign. If a movie is widely loved, chances are you'll enjoy it too. If people envy your career, you're likely doing something right. But investing is the opposite. When everyone agrees with your stock pick, it's often a warning sign. As Howard Marks says, what's obvious to the majority of investors is almost always wrong. Why? Because there's no such thing as a universally good investment, regardless of price. A company like Tesla may dominate the car industry, but if its stock is already priced as though it owns the entire market, it's no longer a bargain. The temptation to follow the herd grows even stronger when friends seem to be getting rich quickly. I made this mistake myself, investing heavily in a startup simply because a friend had made a fortune with it. It wasn't within my circle of competence, but I jumped in anyway, seduced by his success. The outcome is still uncertain, but if it turns out poorly, I'll have no one to blame but myself, except maybe luck. Number 12. Mistakes of omission. Buffett once said,
The biggest mistakes we've made, by far, are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago, or close to it, when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And
the opportunity was right there, within his circle of competence, but he hesitated, or, as he puts it, sucked his thumb. Most of the mistakes we've discussed so far are actions, doing something wrong. But omissions are about inaction, failing to act when the right opportunity presents itself. It's like never asking someone out you really like, or refusing to take a promising risk in your career. Buffett also experienced this with Walmart. In the early 1990s, he started buying shares, but when the price went up slightly, he stopped, waiting for it to drop again. It never did. That hesitation cost Berkshire about $8 billion in missed profits. He nearly repeated the mistake with See's Candy. One of his most successful investments ever, but Charlie Munger convinced him to act. The lesson is clear. When an opportunity lies within your circle of competence, don't nibble, take a full bite. These are the 12 deadly sins of investing. But perhaps you've learned one of your own the hard way. Share it to help others avoid the same fate. And if you'd like to explore Warren Buffett's greatest investments of all time, check out the next video. Cheers, everyone!